Some wonderful advice right now with author David Trahair, chartered accountant of Enough Bull. Here's a look at the cover. You can't miss it. Bright, bold yellow with a bull right in the middle of it. There you go, guys. We're talking about all the things the banks do not want you to know. What should you invest in? Right now, of course, everybody's still on pins and needles with the stock market crash that happened, I guess, a year ago now.
Yeah, the stock market crash, not too many people predicted that, but we all knew it could happen. I never predicted it. But the severity of it has just been incredible. The stock market, the S&P TSX Composite Index peaked June 18th, 2008 at 15,073 points. It cratered on March 6, 2009 at 7,591 points, which is just about a 50% loss.
Wow.
And now the stock market has bounced back, but the problem is that a lot of people make their investing decisions based on emotion. So imagine yourself, at the peak of the market. I actually got an email from a widow in her 70s who had $200,000 to her name, was way overexposed to the stock market. Her value had crashed to $120,000. So her email to me, imagine you're me, what should I do now?
Right. What do you say?
Should I sell and get out? Should I stay and hope it bounces back? She's too old to, wait.
Right.
We have no idea how long it's going to take for the stock market to recover. So there's just so many risks involved.
So what do we do? You say the RRSP is like a gamble. So what are the safe bets, and are there any?
Well, I'm not anti-RRSP. An RRSP used correctly, I think, is the greatest investment vehicle around.
How do we use it correctly?
In my opinion, people should think about reducing their risk to the stock market. In an RRSP, you can hold stocks, bonds, mutual funds, or you can hold simple GICs, guaranteed investment certificates. Imagine this. If your portfolio contained a lot of GICs, every investment statement you got would show a market value higher than the month before. You'd never have a negative rate of return. And furthermore, if you invest it with institutions that are insured by the Canadian government through the CDIC, Canada Deposit Insurance Corporation, even if your financial institution went under, you'd still get your money back. So it's ultra safe. Now, the argument against GICs historically is, well, interest rates are lousy. And they aren't as great as historically what the stock market may do, but the stock market's like this.
Right.
GICs are guaranteed.
Steady.
Exactly. Now, currently with historical interest rates as low as they've ever been, you can still get a 5-year GIC at over 3% a year, which isn't 8 to 10%. But it's never going to be a minus 30%, and that's the key. And
you also say 50 is one of the numbers that we have to keep in mind. 50 plus is when we start investing into the RRSPs, and why?
I call this the tax-deferred RRSP strategy. The reason for that is basically during our spending years, when we're buying a house, raising kids, going on a vacation with all the family. It's very expensive to live.
Tuition fees, sure.
Yeah, tuition fees. Nobody has money lying around to make an RRSP contribution. So basically, anybody who's in any debt whatsoever, even if it's just the house mortgage, is borrowing to make that RRSP contribution. And borrowing to invest, especially if you put the money in the stock market, is a very risky thing to do.
Right.
Because your investments may crash, but your loan never will. Right? You still owe that money back to the bank if you borrowed to invest. Right.
Great tips. For more information, we've run out of time. Enoughbull.ca. Pick up the book in bookstores. Breakfasttelevision.ca. Tons of tips. We're just scratching the surface. Thank you so much.
Thanks, Steve.
Wonderful advice.